The UK just dropped a bombshell of epic proportions, and consumers are warning the unthinkable is on its way. You're not going to believe what's about to happen. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, British workers are sounding the alarm. Fear is rampant, and the unthinkable is looming. And join me as I reveal what's unfolding in the UK and why American workers could be next. Plus, our latest big trade is on fire, and we're about to reveal how we've changed the game when it comes to trading momentum indicators. Stay tuned to the end of the show to learn how you too can cash in big on our next big trade. Now, let's head over to Bloomberg, where we picked today's story up, because I want to set the stage of what's happening in the UK, what the government is doing in response to it, and then we're going to take a look at why consumers are saying the unthinkable is next. The UK escapes a recession threat after posting slow growth in 2024. However, underlying figures suggest the economy is still weak. So while the political elites are celebrating that they didn't have a recession, the problem is the underlying economic data. What's really going on in the real economy in the UK is suggesting things are about to get worse, and what consumers are warning about could happen to American workers next. As living standards suffered a setback as GDP per head shrank for a second quarter running, and domestic private demand was much weaker at the end of 2024. And this is something we've been warning about. We're seeing this happen in the UK, in Europe, in Asia, here in the United States, and all over the world. The demand is going down, and this is a big problem because when demand drops, there's a second thing that's about to follow, and that's the demand for workers. And Capital Economics chief UK economist says a small economic recovery in the final quarter leaves the economy all but stagnating as businesses adjust to higher taxes and more uncertainty from overseas in terms of tariffs. So in response, the government is raising taxes, but what the experts are suggesting is the UK economy is entering a period of stagnation. Now we know stagnation happens when prices are rising, and even worse, unemployment rises with it. Let's take a look at some US data here and show you what is coming for the UK and the rest of the world. As we look at the consumer price index, it blew this on a year-over-year rate of change against continued unemployment claims in red, and continued claims are just a proxy for people who go on unemployment and then get stuck there and are continuing to file claims. And what do we see in the late 1980s? Continued claims bottom out and head higher. At the same time, inflation is running hot and out of control. What happens in the early 1990s? We go right into a recession. Now let's move forward to the late 1990s. What happens? Inflation takes off again, and this time it impacts the labor market just like it did back in the late 1980s. Continued claims rise, and we go right into the dot-com bubble. And then around 2006, we start to see the same setup happen once again as continued claims bottom out. At the same time, continued claims surge. We go right into the global financial crisis. So when you talk about why demand is going down, it's very simple. Consumers don't have the income to afford higher prices, and then they start to see the labor market unwind, so they get worried, and that means the unthinkable is looming. And now look, as we see as of right now in the US, what are we hearing? Inflation likely on the rise as manufacturers are pushing higher input prices onto consumers. The services sector saying, look, we've got to give our employees raises and you're going to pay for it, suggesting that we could see inflation rise over the next several months. At the same time, continued unemployment claims, while they're stagnating at their current level, are threatening to break out to the upside, suggesting what we're seeing here in the US is the same scenario that's happening in the UK. Is we're heading into stagnation, which means the UK economy is facing a recession as well as the rest of the world. But household spending was flat, and there's the evidence of it. We see demand just dropping against higher prices, and an even bigger red flag, business investment dropped 3.2%. So when businesses see demand fall, well, they don't invest in their business. And of course, that lack of investment pushes right into the manufacturing sector. As demand drops there, well, what do you think happens next? And that means people get the pink slip. And UK's faltering performance poses a headache for Reeves, who may have to find savings, or even worse, look at this, the UK government potentially facing another round of tax increases to meet the fiscal rules next month. Can you imagine that, being heading into a period of stagnation where you're seeing rising prices and rising unemployment, and the government's response is, we're going to raise your taxes. You want to see demand in the UK plunge even more, or you're about to see that. But something that should be headed higher multiplier, and that is your trading account. This is our latest big trade. This one on the books on January 16th. It was a pair trade. It hit both our CTA Time Pro and our Momentum Time Pro subscribers. It's up 11.83%. We gave our subscribers all the notes on this. Now we're changing the game when it comes to trading momentum, because a lot of people try to trade those signals and they get into oversold territory and think this is the time to buy, but they're missing out on one key indicator. We've added that to our report. It's called Momentum Timer Pro. When the trend is up and momentum is backing it, you get high probability trades, and that's what we deliver to you each and every day. Grab those links in the description below, use a coupon code, or stay tuned to the end of the show for more information, as last week they voted for the third interest rate reduction of the current cutting cycle. So the government, in response to this, is saying, well, perhaps we may have to raise taxes even more. And of course, we know that's not going to help. But the central bank says, you know what, we could step in here. We're going to make a big difference. We're going to cut interest rates. The problem, as we know, that lowering interest rates does not do anything and doesn't help at all, although stuck by their guidance for a cautious easing of policy. And why are they cautious? Because inflation is rising. That's the big issue here, is that inflation around the world is not slowing down. It's turning back up. It's a huge risk, because we know what comes in periods after stagnation is a massive decline in demand. Of course, with a big drop in unemployment, inflation is going to be the last concern on policymakers' minds. And doves on the BOE committee are growing increasingly concerned that a growth slowdown requires bigger rate cuts. Yes, it's going to mean massive rate cuts all the way back to zero. The question is, will it make an impact? Do you think rate cuts actually make a difference in the real economy? I'd love to know what you think. Weigh in the comments below, because this chart says they make absolutely no difference. As we look at, again, U.S. data here, this is real retail sales shown in blue on a year-over-year rate of change against the federal funds rate in red. And what these policymakers want you to believe is, when there's a slowdown, as we saw that started back in late 1998 in retail sales, if you cut rates, that consumers are going to come out and spend big. And yet, well, the Fed cut rates from over 6% all the way down to 1%. And it wasn't until you got below 2 that we saw a kind of a bottoming effect in retail sales. But let's move forward to 2007. What did we see? A slowdown in retail sales to begin way back in 2005. But around 2007, the Fed started to get worried. They cut rates from just over 5%. And it wasn't until they got to under 1% that we started to see a bottom in retail sales. And look at where we're at now. We've seen 3 years of nearly negative real retail sales. The Fed's starting to cut rates. And what are we seeing from U.S. consumers? What do we see in the retail sales data on Friday is a massive reversal, a big drop in demand. And this is a huge red flag, because what it's telling us all around the world is rate cuts do not work. They don't have the intended consequence on the economy, which then in turn is why UK consumers have just put out a massive warning to the world, as unemployment fears are getting in the way of a UK consumer boom. And it's very obvious, when people are worried about losing their job, one of the first things they do is they cut their spending. And that's a big problem when you're already seeing demand go down in the last quarter. The issue facing the UK economy is one that, as you're about to see, is going to spread all over the world. And unemployment expectations rose to a 2-year high in January, according to a recent Bank of America report. Separate figures from the Recruitment and Employment Confederation published Monday showed companies are paring back job postings at the steepest pace since the midst of the pandemic in 2020, and increasingly turning to redundancies. And so this is something that we've been seeing in the U.S. data. The job openings are on the decline, and this is a big red flag as well. And what we note is, when job openings decline, well, the unemployment rate goes up, because it makes perfect sense. If a business owner says, look, I don't need any more employees, I'm going to pull some of these job openings off, what's the next thing that's going to happen? They're going to cut hours, and then they're going to cut jobs. And you're starting to see why UK workers are flashing the biggest warning they could, saying they're about to hit the unemployment line. The problem is, a lot of other workers around the world are soon to follow. And the miserable outlook was reflected in the Bank of England's latest monetary policy report last week, as officials warned of lower growth and higher unemployment while cutting interest rates to 4.5%. So despite the fact that the political elites want you to believe that rate cuts matter, there they admitted it. We just cut rates to 4.5%, and guess what? We're warning there's going to be lower growth in the future and higher unemployment. So if rate cuts worked, why did they stop at 4.5%? Why didn't they go to 4 or 3 or 0 or even negative? Because they know it doesn't work, and they're telling everybody the UK economy is headed right into a recession, and the workers there already know this is going to happen. And you can see the effects of rate cuts on the labor market. Well, there are none, because when we look again at the US data, we now start with continued claims once again in red. We go back to the late 1980s, and what do we see? Continued claims bottom out, they head higher. At the same time, the Fed's aggressively cutting rates. And you'll notice it has absolutely no impact on the labor market. The same no impact happens in 2000 when continued claims are surging higher. The Fed is aggressively cutting rates. There is nothing that rate cuts do to stop the slowdown in the economy, and it didn't do it going into the global financial crisis. Despite the fact that continued claims were surging, people were losing their homes, all the Fed did was cut rates, and it absolutely did nothing. They had to stay at 0 for over 5 years. And now look, once again, the U.S. economy is facing an inflection point where continued claims could head higher. The Fed's cutting, and eventually they're going to have massive cuts. The problem is we already know it's not going to do anything. And what did you just see from the Bank of England? They said, look, we cut rates, growth is going to slow, and unemployment's going to get worse. Well, then why aren't you doing more to stop that? Even though people still see strong wage growth in the UK, they might not spend more because they're worried about losing their jobs. This from a senior European economist at S&P Global. And yet, once again, you're seeing these experts, they don't actually get it. They think, well, wage growth should be pretty good, but for some reason, because people are worried about losing their job, they're not going to spend more. Well, that's obvious. Anybody who is worried about losing their job is going to cut their spending. But what they don't understand, and this is a reason I started the show out by giving you a pulse of what's going on in the UK economy, is they're saying demand is down. And despite the fact that demand is down, wage growth is rising. And why isn't rising wage growth leading to more demand? It's because these experts don't understand. Inflation's too high. It's still way too high. And the damage from high inflation coming out of the pandemic damage household budgets to a point where they're at the mercy now, where they're about to break and demand is going to crash. Let's take a look back at the U.S. Consumer Price Index, once again shown in blue, against average hourly earnings of production and non-supervisory employees, that in red, both on a year-over-year rate of change. And we can see very clearly that back in the late 1980s, we saw inflation rising, but wages were rising too. There was a problem. At one point, wage growth peaks, starts to roll over and head down, and what happens? Inflation goes higher. There's that recession. And then what happens in the late 1990s? Well, once again, inflation takes off, but at this time, wage growth remains fairly high. It remains at a good point. The problem is inflation then rises too fast. Wages don't increase enough to offset it. You go right into the dot-com bubble. And then you move forward to 2006. You think, well, everything's going to be good because wage growth is running at a really good clip once again. Problem is, energy inflation takes off. Since the consumer price index surging, wages don't keep up. You go right into a global financial crisis. This time, the experts are saying, look, wage growth is higher than inflation. So what's the problem? This is a good thing. Everything should be working itself out. The problem is, post-pandemic, there was a period for a couple of years where inflation was running well over wage growth. What happened is workers all around the world took on massive amounts of debt. They got way behind the bubble, and now it's too little, too late. The damage has been done. And unemployment fears are a risk to the UK economy even if job losses turn out to be modest. The Labour government has promised to increase growth, but will still struggle to do so in the short term without a rebound in consumer spending. That's because governments don't know how to create growth. Again, look to what the Bank of England just did. Hey, we're cutting rates, and guess what? It's going to lead to lower growth and higher unemployment. Clearly, governments do not have an answer to this. And Britain's savings ratio, however, has stayed high by historical standards. Well, it makes perfect sense. Once again, when consumers are faced with losing their job, the first thing they do is start increasing their savings, and they cut their consumption because they don't want to be on not just the unemployment line, they don't want to be homeless when they lose their job, so they have to boost their savings. This is the natural effect of a slowing economy. And over half of UK adults said last month they're reducing discretionary spending to cope with higher costs for essentials. And this is exactly what I've been warning about. I've been saying that as consumer prices go up and wages don't keep pace with them, that it's going to impact the discretionary side of the economy and it's going to lead to massive job losses. This is exactly what UK workers are warning about and what's going to happen all over the world. Let's take a look at the recent S&P Global UK Manufacturing PMI, where we get further evidence and confirmation of this as we see manufacturing downturn continues as companies face weak demand. Well, it's obvious because inflation has consumers focused on essentials, not discretionary. They don't have the money to afford it. And look at this, low confidence and rising costs. This is exactly what we're starting to see in the U.S. data. Now let's dig deeper because the level of incoming new business decreased for the fourth straight month in January. Now guess what? If you don't have enough work to keep your workforce busy, the first step you do, you drop those job postings, then you cut hours, then you cut jobs. But let's take a look because the backlog should maybe give us some evidence there's plenty of work, but we'll find out it's not there either because signs of excess capacity and low levels of business optimism also contributed to the latest reduction to staff headcount. Backlogs of work fell for the 33rd month running, with small-sized manufacturers making the largest inroads into work at hand. And so this is what workers are worrying about. They're saying, look, we're not seeing the new order book come in. We're not seeing it expand. And in fact, as we go to work, we continue to take care of those backlogs. And after 33 straight months, there's not much left. And when that's gone and there's not enough new orders to keep us busy, we know our job is gone. And that is, my friends, the major warning they're putting out to the world. In January, saw a resurgence in price pressures with input costs and output charges both rising at accelerated rates. Purchase price inflation hit a two-year high with the steepest upswing at consumer goods producers. Exactly what we're seeing from U.S. manufacturers. They said the same thing. Input costs are rising, and we're going to pass them on to consumers. And look at what we just saw happen in the UK. Consumers saying, we can't afford these higher prices. Manufacturers say, well, guess what? You're going to get even more higher prices. The problem is, it's going to lead to even less demand. And of course, workers already sounding the alarm. But now let's turn to the services PMI as new work declines for the first time since October 2023. Now remember, the services sector was supposed to drive the global economy. This is what we were told, that everyone went crazy buying goods during the pandemic, and now they wanted services. And not to worry that even though there was a slowdown in manufacturing, the services sector would propel it higher. We said that's not how it works, and sure enough, it isn't how it works. January data indicated a marked reduction in backlogs of work across the services economy, which typically reflected spare capacity following a sustained period of weak demand. The latest decline in unfinished work was the sharpest since August of 2023. So once again, just like we saw in the manufacturing sector, there isn't enough new work in the services sector to keep the workforce busy. They're focused on backlogs. As those backlogs go away, they're going to hit the unemployment line. And the other risk here, as we see demand in terms of capacity at factories and businesses decline, well, that means price pressures are going to decline with it in a big way. And staffing numbers were reduced for the fourth consecutive month. The rate of job shedding has accelerated at its fastest pace in some time. So once again, you look at what workers are worrying about, and they're telling the government, hey, we're on the wrong path. And what's the government's response? We're going to raise taxes potentially. Central bank says, look, we're cutting rates, and that's not going to make a difference either. And that's why workers there are massively increasing their savings, because they realize the government cannot stop what's coming. And rising salary payments and efforts by suppliers to pass on higher payroll costs contribute to the strongest pace of cost inflation since April of 2024. Just the same as U.S. services employers said. They said, look, prices are rising because we have to give our workers more income, and we're passing that right alongside to you at the same time. Demand is going down. So when we look at what's going on in the UK and around the world, what we're seeing from UK workers, they're warning everyone, look, we're on the brink of mass unemployment. Problem is, we're not the only ones. You're going to be right behind us. This is a risk. This, my friends, also coming to America. But something that can change the game in terms of your household income is making money in the markets, because no matter if they go up or down, we show you how to make money. Let's take a look at our recent trade. This was Bank of America's top sector in the economy. So you want to make money, you should be here. We got our subscribers in back on January 16th, not only for our subscribers that trade machine positioning, but also our subscribers that trade momentum. We gave them those. You don't even have to read the reports, because when it comes to trading momentum, people look for these oversold levels. They look at the RSI and the MACD and they say, look, when they get to oversold, I got to buy because that's what I'm supposed to buy. The problem is, if the trend is still down, buying at an oversold level, well, it can quickly reverse and go down even more. We changed the game because we recently updated our proprietary overlay. We made it even better, and now it looks, and when it verifies a potential rising trend against a big swing upward in momentum, it puts a buy signal out, and that means back on January 16th, both reports flagged a buy signal, and this is taking off massive. 11+% return, and you could have been in on that. How do you do it? Just sign up for the reports, and below each report, again, you don't even have to look at them. We give you the notes, we tell you which trades, we give you the risk control levels, we give you everything. You get the daily reports, you get the tradable signals. I go through every trade and tell you these are the ones you should take a look at. We back tested it. We have risk control levels. I even disclose my personal trading account, and then once a week we give you a full update on all our positions. Here's the best part: we're so confident that you can make money trading. We give you a free 30-day free trial. In fact, you've just seen recently 2 big trades that you could have jumped in on. Grab the links in the description below, use those coupon codes for a 30-day free trial, and start joining us and make money in these markets. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.